Yeah, as the market moves more positive rather than the period of time where the market was more volatile regarding tariffs that have been coming up, getting more emotional for investors. Is this a better time to buy or a worse time to buy?
It's usually a better time to buy when uncertainty is around. I mean, those invariably are the best opportunities to give you as far as purchases is when everybody else is running towards the door and feels sick to their stomach. So, yes, you just want to stage purchases as far as for how that's done, so that you're not saying, I want to buy everything today. You just want to buy pieces because you never know exactly where the bottom's going to be. But if you stage those purchases when you see good buys and you continue to keep doing those, you're going to get below market values as far as for investments.
So when there's a moment throughout the day when something happens in the news and people are startled by it, whether it's tariffs, taxes, something like that, is that a good time to buy? Because right at that moment there might be fear in investors, or no, wait a little bit longer until that is shown in the market?
I don't mind nibbling on pieces throughout the days as that goes as well too, because as for instance, I mean, Google had news the other day, they got clocked. It's not like they haven't been investigated before, and
Right.
certainly won't be the last time. And you get a knee-jerk reaction where everybody goes, well, all right, I don't want to own it now because who knows what's going on. Well, we'll do the same thing in Europe when they have a big thing over there. It certainly won't be the last one. So do you buy it then? Yes. I mean, does it go up 10 points the other day or another 10 points down? Sure. Buy a little bit more. I mean, when you're trying to size a position, you ultimately want to figure out how much you want to have and essentially work into that position.
And during times of volatility, would it make sense to sell, let's say Google, which has been volatile right now? Would it make sense to sell once it's up 10% because we're looking at volatility, or no? Make the first purchase or second purchase at a low point and wait for it to go up more than 10% rather than taking advantage of the volatility.
And I look at those positions as something that you want to have for a longer period of time. If it's something where you say, this is the company I want to have, and it's not just through 3 months or 10%, where do I think this company can go? When we look at when Google came out versus what it's at right now, what is it? I mean, 20 times what it was, 100 times what it was. I'm trying to think. It came out at 100 and it's worth 2,000 post split adjusted. So yes, a lot. Is it over as far as the ride goes? No. I mean, you're going to have a lot of regulators stepping in. I mean, the reality is governments need revenue nowadays, and how do they do that? They basically file complaints against companies and make them pay. I hate to say that that's what they're doing to essentially go through and fund their services and what they need to do, but the reality is a big chunk of their money comes that way. Does that mean that the company is not going to be good, or they're going to dismantle it moving forward? Depends on the company. Google probably not, as a for instance. Some of these other companies probably not. What do they have for replacement? What are they putting on? So then the question becomes is how much do you want to own? How long do you want to own it? Is the company meaningfully changing what it's doing and its growth along the way? You just have to judge that by fundamentals, or I like to add technical analysis to fundamentals. When you're purchasing assets, you're not essentially just buying it high all the time. The hardest time to buy things is obviously when they're the most volatile, but you get the best buys then. You just have to get used to doing that, and people that are close to their money have a very difficult time doing that because it makes them sick to their stomach.
Right.
And invariably that's why we're in business, because people have a hard time doing that. We have a much easier time doing that, plus this is something that we do every day. It's not just something that we go home and look at it for 10 or 15 minutes, or even an hour if we enjoy it. So no, how long do you want to own the company? How big a size do you want to have? If it becomes too big a size as far as the portfolio, then you just pare it off on the highs a little bit. But if it's something that you want to own for 20 years, you want to know the volatility you get here in the short term, assuming the fundamental companies are still going to be good moving forward.
And when buying, so continue talking about Google right now with possible antitrust issue coming. So people are scared, and the price goes to $1,000, and we're looking at making that 5% of the portfolio. But you buy the $1,000, and the price continually goes up. So you got it at a price. Would you continue to invest or no? Because you got it at $1,000, and there's no way to lower the cost basis in Google.
What's the reason for owning it? If 5% is essentially the size that you're going to have in the portfolio, let me make sure I'm understanding the question right. If 5% of the portfolio is essentially what you want to have as far as Google goes, and you've essentially got the 5%, is that what you're saying?
No. So when we purchase stocks, we generally do that, let's say 1/3, 1/3, 1/3, 3 purchases, because nobody knows where the bottom is. Nobody knows when volatility is
the crystal ball just didn't tell me anything.
So if we decide to buy, and then at that point, so if it's 5%, we buy 1/3 of that 5%, and then the market brings the value up. What would be the next step?
I mean, patience is something that you want to have. So if what you're saying is, I bought it here, but I don't really want to own it at this price, okay, that's fine. And just have it on your list as far as for when it settles back again sometime, then you add to the position. It's not to say that what you bought as far as the portfolio doesn't, grow to that size of a position over a period of time. That very well could be. Mm-hmm. But you never expect that you're going to get complete size on everything that you purchase. So patience and buying at the right price doesn't mean that you're going to have a full position. It just means you're going to have some things in there that you bought at pretty good prices. You've got a list of things as far as for what you want to add to. Some you're going to get to those pieces. Some you're going to go, oh my goodness, I got to that and the stock is still down farther. Do you go above that piece then at that point in time, or you retain your discipline and say, you know what, this is the company I want to own, this is the size I want to have it in, this is how adding this piece to the portfolio mitigates risk, I don't want it to become too big or too small, etc.
And so under the circumstances where the price goes up, and we can be patient because we figure a good price is $1,000, how long would we be patient? 6 months, a year, 2 years, until the price of the stock goes down?
I mean, the way that you would look at that is say, at what price do I want to own this up to? If I bought it at $1,000, I say, I don't want to own any above $1,050. I don't mind buying it at $1,000, but I don't want to buy it above $1,050. Then you don't buy it above $1,050. Okay. And you could be patient on that until the next, correction as far as the markets go, where it takes just about everything down. Because usually you will have a correction, an 18-month correction a 10 to 15% correction in the markets every, year and a half roughly.
Right.
Could be that long, could be longer than that. 20% correction usually every 2 years to 2.5 years. So it could be that long, where, the market indiscriminately takes everything down. Well, you might be able to add that, you get 1% or 1.5% in that piece, and now all of a sudden now you can get a full position on that. So, and at that point in time, that might not be on your list anymore. You might look at that, and 2.5 years from now, things change in the company where you go, you know what, that's not something that's on my list anymore, and you prune it. It might be something else that you add, and it might be something where fundamentals change in the company over that period of time. Before you get the correction, you say, all right, I don't want to own that company anymore. We appreciate at this point, let go of that partial position that you have, just because it's not something you want to have in the portfolio. It needs to do one of two things anyway. I mean, portfolio allocation and diversification are designed to do basically two things: reduce risk, increase return. Period. That's it. And every piece that you add to a portfolio, you need to look at that way, because if you're adding fixed income to a portfolio, you're looking to mitigate risk. You're not looking to make a killing on fixed income. You're looking to put some buoyancy in the portfolio and make sure that you're essentially mitigating the equity risk, because you don't want everything to go up and down at the same. Yes, it's wonderful when the whole portfolio goes up in value at once. It's terribly distressing to people when the portfolio goes all down at once. So the idea of asset allocation and proper diversification is there's always going to be something in your portfolio that you're not going to like in any one year. That's just the way it's supposed to be. If that is indeed the case, then you've done proper diversification and portfolio allocation. And there's times where that works really well and times that it doesn't work at all. I mean, where you don't get any additional performance of the portfolio and you don't get any reduced risk. You get everything just not doing anything. But in most years, you'll get at least price performance and risk mitigation. The question is how much. So that works very well that way.
When diversifying a portfolio, does it make sense to diversify in a similar percentage to different indices, whether it's the S&P 500 or the NASDAQ or the Dow Jones, or maybe that's not best case scenario for some clients?
The thing that's most important is risking the portfolio correctly to what the client needs, and then managing that risk. You never know what you're going to get as far as return on the portfolio. You just never know. You know how much risk you're going to be taking as far as in the portfolio, or at least you should know how much risk, and the client should know how much risk they're having as far as the portfolio. Then how you essentially construct that is a matter of managing risk. It's one of the most important things we do. I mean, once we know what the client's objectives are, then the question becomes is how fast we get them there. Mm-hmm. And that's a matter of client demeanor, behavioral finance. I mean, how well they sleep at night. Take their temperature, whatever. But that you want to make sure that in periods of time when markets essentially sink. I mean, we saw a 20% correction in December. Who comes unwrapped? I mean, we're essentially buying into those scenarios when people are going, no, I can't possibly do that. And they are always selling into those scenarios if they don't have our help. And that's just the way behavior is with individual investors. That's the way it is with a lot of professional investors. They are on the other side of the market. That's what gives us opportunities as far as that goes. So what you're adding as far as the portfolio goes depends on what your opportunities are, what you need to mitigate risk as far as in the portfolio, where your slants might be from a perspective of going, this particular area looks fabulous moving forward, this one doesn't. Do you buy the index saying that, I want all the stuff that's not going to perform as well too? No, ideally you want to do at least some research and say, okay, if I'm going to have some tilts, well, let's do tilts in the portfolio that make the most sense. Is it going to be internationally based? Is it going to be domestically based? Is it going to be consumer? Is it going to be technology, etc.?
So during the 20% correction, would it make sense, we're buying things basically on sale, would it make sense to say, you know what, we're going to buy equally energy, utilities, technology, domestic, international, or would it make more sense to tilt to a certain industry that was decrease the value greater than another one? So if technology was decreased more than energy, greater purchases in technology afterwards.
And I mean, you tend to look at that from a discount as far as what are my growth opportunities moving forward, and is this just take all the soldiers out and shoot them at once kind of thing where everything sells off, or were there good reasons for this piece of industry to be beaten up more than others? I mean, healthcare industry right now is constantly in the news because both sides of the aisle want to beat up healthcare providers, costs, everything else to take all that out of it, and it essentially just casts a pall over everything. Now, if it's going to be continuing good long term and they just took it out and shot it for no reason, then ideally, yeah, you do want to buy that. But when you essentially have bounces as far as markets, it's not unusual to have the low quality, really sold off, throw the baby out in the bathwater kind of things move further because usually the schlock kind of moves up first. Or strongest, I should say. The heaviest growth, discounted for no reason, typically has a good bounce as well too. It doesn't mean that you don't buy an index. Indexes are going to bounce too. I mean, regardless, you've got a lot of money going into indexes that go right across the board and say, I just want exposure to the index. It's the easiest way for them to make the trade. Big money goes into that, allocated across the index the way it is, and you get great movement. the thing that you want to make sure of is that you're going to get participation. The indexes will give you participation. If you're doing your individual stock work and you're going, this one should move, well, that doesn't mean it's going to. So is participation in the move more important than the individual stock in the portfolio? In that kind of scenario, I would tend to say yes. I'm eliminating headline risk, I'm getting exposure quickly, and I'm getting participation on the upside because we know that the indexes are going to go up in that scenario.